Good afternoon. Welcome to the online workshop or webinar. My name's Andrew Talbot, and if you're doing this live and you want to ask questions, by all means, please just do it in the chat box. If you want to do this because you're watching this live on YouTube, then by all means, send me an email and there'll be some details at the end about how to get in contact. Today, we're going to talk about the 3 factors that affect how you make money. Okay, we're going to nail it down to three factors only, and everything else is just noise. So let's start with components of financial planning, just to set the scene so that you understand where these other factors come into it. So I think there's 3 steps, always 3, about why someone would actually do an investment. The reason why is the most important question. Are you doing it because you want to retire? You want to give money to your kids? You want to buy a house? You want to send them to university? You just want to have an investment portfolio. There's got to be a reason why someone does an investment. How you do it is the next stage, and there could be lots of different ways to achieve this. You could just buy a property. You could buy a couple of buy-to-let properties around the world, because that will give you an income to supplement your retirement or base your retirement around. That's the why. The where is, well, where do you buy those houses? They could be in Southeast Asia, they could be in Australia, they could be in the UK, Europe, US. It's just the detail that goes with it. It's the same with an investment. You can have an investment platform as the vehicle, but you still need to invest. So the where, the detail could be an ETF, it could be an investment fund, it could be buying the FTSE, or it could be buying the S&P 500. It's the detail to make sure that the vehicle and the why works. So what are those 3 factors? First one is cost, second one is asset allocation, and the third one is human behavior. If we start with factor 1, which is the cost, or the cost of the investment, this will dictate whether or not you make a return. So the higher the cost, the higher return you need. If your insurance policy or investment platform or your property is costing you money per year, say 4%, then you'd need to make more than that 4% in order to make a return. And if you wanted to add inflation in, say 2 or 3%, then you probably need to make 6 or 7 before you actually make a real return. So the cost of investment is extremely important. So understand what your investment costs are. And this could be the cost of advice, the cost of myself, as I said, the cost of the platform, insurance policy or investment vehicle, and then the cost of the actual fund, the detail. So there might be a fund manager, there might not be a fund manager. But understanding where that cost comes from and how the fees work will have a big indication of whether or not you make a return. UK supermarket is fond of saying every little helps, but I think when it comes to investing, it's more of a case every little can help a lot. That's because every dollar or euro or pound you pay in costs is $1 off your returns, and the longer you are invested, the more this compounds over time. So that's the statement to think about when you're doing costs. If we took Berkshire Hathaway, which is Warren Buffett's investment fund, extremely successful, as everyone well knows, and you invested $1,000 in 1965, it will be worth about 8 million at the end of 2015. So this data is a little bit out of a couple of years out of date, and it's produced by Fundsmith, which is a fund. But the concept holds true. So $1,000, 1965, worth about 8 million at the end of 2015. Now, if you applied a hedge fund charging structure to this, which they take 2% and then per year, and then 20% as a performance-based fee. So a pretty standard, as the industry calls it, 2 and 20 charging structure, or fees to invest in a really good manager. And I don't think anyone can disagree that Warren Buffett is one of the best managers to invest in as per his performance. Up until 2015. But you can see the difference in what you would get back at the end of it. So you get 8 million if you just had a if you just invested in him, right? You just bought the share. But if you put 2 and 20 on it, then you get back 720,000, which is a very good return, but it's not 8 million. And the 7.2 million would have gone to the fund manager. So there's a big difference between what you would get just because of the cost structure. So if you understand, okay, what's my investment fund costs, what's my platform, what's my advice costs, it can make a huge difference to whether or not you make any money. So lower investment fees, higher amount you end up with. And it works the other way on this seesaw. The next step, or next factor, is asset allocation. So given enough time, and you're investing in the great companies of the world, such as Apple, General Motors, Unilever, all of these companies that produce products, you will produce a better return than investing in fixed income or cash. And we'll go on to some examples of this later. So once you've identified all those, your goals, your objectives, you take into account you need emergency cash or emergency money and all of the other contingencies, you should be investing that cash surplus. And it's quite a simple statement, but it doesn't necessarily mean that that's what people do. It's simple, but it's not easy. So the longer you don't need to spend that cash, the more it should be invested in equities. And we'll come on to some of the factors that will affect this type of statements, because it's quite a sort of bold statement to say that you should be invested in equities. This is the S&P 500 graph, okay? All the way back to about 1926, I think it is. You can see that in any 1 year period, from the box on the left, you will produce, on probability, 70% of the time, 73% of the time, it will go up. So that means 27% of the time, it will go down. So 1 year period. 3 year periods, it goes up to 83, 5 year up to 86, 10 year up to 96%. And over 15 year periods, you will make money 100% of the time, just by staying in it, which will come on to the human behavior of this. But the asset allocation is that if you don't need to spend that money for a 15 year period, then you should just leave it in equity. And the S&P 500 is just an index of the 500 biggest companies in the world, mainly in the US, and we'll come on to some other reasons in shortly. So what about the history of declines? Okay, so this data is up to December 2018, so it's about a year out of date. So the last occurrence, you can probably ignore that. But if you look at the type of decline that happens in a year, so minus 5%, this would happen on average about 3 times a year. And it happens, normally average length is about 44 days between them. 10% happens about once a year, 15% happens about every 4 years, and minus 20% it happens every 7 years. So markets are predictable in this sense, that there will be falls and there will be highs. You've got to understand, okay, this is what markets do. So it's more to do with you understanding the factors and then not applying your human behavior when it comes to it. But be invested, get your allocation correct. Let markets work for you. We said that markets will reward long-term investors. So the longer you're in it, the more money you will make. This splits the allocation further into effectively US Treasury bills, which is fixed income, and long-term government bonds, fixed income. And then you've got equity, so large US equity, which is the S&P 500. And then you can concentrate further down into US small cap, so smaller companies. They tend to produce a lot more return. They're a lot more volatile though. So if you invested $1 in 1926, then the US inflation will mean that it's worth $13. Treasury bills, you'll probably make about 21. Long-term government bonds, you're a little bit more on 134. And then once you get into equity, that dollar will turn into $6,000 in 2016, which you've got this data from. And if you did small cap, then it's 20,000. So you can see the difference just by investing your allocation. If in cash, it will just be worth 13. If you're in equity, it's worth 6. And that's the US large cap. If you're in small cap, it's worth 20,000. So there's a big difference. So let the markets work for you. Practice smart diversification. So we had that graph earlier about the S&P 500. It's 500 stocks, namely one country. If you took the global market or the index, so we've used the MSCI or All World Index. It's an index that has 8,000 stocks in 46 different countries. That is a globally diversified portfolio. And avoid market timing. So this will come on to human behavior very shortly, but you can see just by that matrix where all of those colors were representing the asset allocation on the left, so US large cap, real estate property, international large cap, international small cap, emerging markets. These are all indexes or concentrations around the world of shares. And they just put it into a particular index. You can see that it's just all over the place. There's no way you can predict what would happen to individual components over this period, which is 14 years. You just don't know. So just by being in it rather than trying to time it will probably make a big difference. And that is human behavior, which is factor number 3. So when equity markets start dropping, do you get a tinge of fear? Do you feel envious when you hear other people's investments are beating yours? This is how human behavior investors will have an impact on their return. So once a plan is in place, you need to stick to it because it's fulfilling your goals, your objective, your plan. It's not anyone else's. And those bad decisions will affect the plan. So time in the market rather than time. It's just a saying, but it really does apply when it comes to investing. You've got to take your plan and avoid some of the noise that happens around it. You can see by this graph from the behavior gap how it does make difference. If we were to add a few more words around that, you get optimism, inflation, elation, nervousness, fear, optimism. These are the reactions or the emotions that an investor will go through when they're looking at their particular investment. And it will get amplified by the news and how you react, what sources of information you are looking at. So you can have stuff like daily market news or commentary saying sell stocks now, there's a looming recession, these are the top 10 funds to hold, markets hit record high, the housing markets have boomed. Got to look beyond these headlines and control what you can control. So your plan is individual to you. You can control it by diversifying globally or not having cash or not investing in a particular concentrated portfolio. You can manage the expenses, you can manage the turnover, you know what the cost is, you know how the allocation works. You can stay disciplined. This is what you can control. There's things that matter and things that you control and focus on the bit in between. There's some things that you just can't control, such as what Donald Trump sends a tweet or the trade war between the US and China. There's nothing that you can do about that. Markets will go up, markets will go down. So tune out the irrelevant information, stick to your financial plan, resist the urge to follow the herds, and avoid the emotional roller coaster and remove that temptation. If we did a quick investment quiz, I've got a couple of other things to do as well. What should investors do? Really simple question. You want to buy high, buy low, sell high, i.e. make a profit, buy high, sell low. Put your money in a big pile and burn it. So you can imagine you see a story that's all over the news, a new hot company that's got an amazing product, something like the next Apple or Tesla. Should investors check out the company and potentially invest, or ignore the news and invest as before? If you go back to the first question, we know that buy low, sell high is the right answer. But if you look at the second question, you know it's a trick, right? Ignore the news, invest as before is probably the right answer. But you need to check out the company and potentially invest. It's words like hot, hit, can make a lot of money. And this is what behavioral scientists call the social proof. We are naturally drawn to people that are saying these things and you want to get involved with them. Investing isn't natural. People like an investment, the price goes up, price goes up, all things being equal, you're buying high. Just like putting money in a big pile and burning them. Which comes back to your own plan. The plan is only for you. So control what you can control and ignore what we call the financial pornography of the news. Lots of red and lots of green, depending on what the time of the day is. So let's play this game, time the market. Okay, so I'm going to try and time the market. I don't know when these periods are, but you can see there's some news headlines here. I'm going to invest $10,000, all right? So let's see how good I am at doing it. So the news version is that the stock market's had a stunning quarter. All right, we're still down 20%. Okay, should I sell? Many investors fear to join, so I'm going to get out. There's a lot of unrest going on. Right, natural gas. Oh, damn, I should be in. Okay, I'll get back in because, okay, investors are making money. Stock market's crazy. It's going well. Okay, should I sell? No, I think I'm going to stay in. It's still going up. I don't know what to. Coming to the end. Okay, I didn't do very well. I didn't beat the market. If I just left the money in there, I would have made $35,000, but I only grew by 26 because I came in and came out. So I lost $8,000 just by trying to time this market. And this period was from 1987 to 1997. Okay, so it covered a lot of events that would have happened. You can see down here, you had probably the Japanese markets, you had Europe booming, we had the 1987 crash. So trying to time it is incredibly difficult. And play the game yourself, see how well you can do. So coming back to your plan, the amount you need to save for retirement or whatever goal you want to do is the amount that you need to spend in retirement. So don't let bad advice put you off good financial advice in the future. And we cannot recommend investment portfolio for a client without a financial plan. So the plan determines the rate of return that you need to do to plan your successful conclusion. No plan, no portfolio. So proper financial plan or a life plan is something we should all put in place. And it could be a list of financial goals, things that you want to do, your bucket list, for instance, and we add it all into a timeline. It's all about you. And then we build the portfolio based around what you need to achieve. We do this by using the world's market leader in financial planning software. So it's a bespoke plan based around you. If you want to get in touch, these are the details here. Email, mobile, Facebook, LinkedIn, Twitter, all those different social media ways to do it, or even on the YouTube if you're watching it on that channel, just in the comments below. So thank you very much, and I hope to speak to you soon.